Welcome. This is the Trading Pay Your Home for sophisticated takes on the crypto markets. It's May 9th, and here in the studio is JJ and Benjamin of JLabs. I am your host, Marconi White, and today's show is going to be about flows and when is this range going to finally break? Gosh, I want to know. You want to know. Everybody wants to know. But first, it's rapid fire, where I look for simple answers to complex questions. And man, we got some good ones today. Benjamin, JJ, you better grab onto your seats and get ready to answer some of these. All right, Benjamin, I'm kicking off with you. What happens first? AI dominance or hyper cryptoization?
AI dominance.
Oh, how quickly does it happen? Next year, year after?
I think in another 5 years.
5 years. Oh, so you wow. Man, I figured it was going to be tomorrow. Everything would look like Skynet. We were all just going to be, or maybe it's the Matrix. We're all taken over by something. All right. Well, 5 years is a ways out. I was hoping for something a little sooner so I could stop worrying about the world. JJ, on bits and bips, Alex Kruger is seen with 20 charts open at once. Is it too many, not enough, or just right?
I would say too many, but then I think about how many charts I go through over the course of the show every time we do it, and it's about 20, so it's probably just right.
I think you need more monitors. I saw the background. It looked like something out of a professional studio. Benjamin, VanEck unveils meme index. Is this a top signal, or are we just getting started?
Getting started.
Okay. I think anytime you hear memes, you're just okay with it. I'm wondering if you've got some tattoos somewhere. JJ, the U.S. Japan reportedly agree on FX intervention. Is this the sign of worry, or is everything going to plan?
I think it's all going to plan.
Oh man, that conspiracy tone in your voice, I could hear it. All part of the way that we're going to get crushed by the soul of the U.S. dollar. All right, Benjamin, the FTX plan. This one's long, so pay attention. The FTX plan, which proposes to compensate customers with $50,000 or less worth of assets on the exchange, which is about 98% of users, offering them 118% of the value of their assets at the time of the company's bankruptcy filing. Woof. Is it a good or rotten deal?
It's good if it is accepted. If it's accepted, good. It's a good deal.
It's a good deal. All right. I know you're not a legal scholar, but you'll take the money and run. Fair enough. Fair enough.
Yeah.
JJ, last one here. Grayscale withdraws ETH ETF future submission. Should ETH holders be worried?
I think that's a non-event.
Oh, really? Anything to add to that? A sentence or two?
No, it's just Grayscale futures ETF product. I don't think it would have been that big of a deal, even if it was approved. I don't see too much implications there.
Oh, all right. All right. Okay. Well, there we have it. I was hoping for a little bit more drama, but I'm going to take what I can get. You know what? I'm going to throw in a bonus one. We got Taipan says jobless claims for last week, 231,000 versus 211,000 forecast. Is this bullish for rate cuts? Benjamin, thoughts there?
Market thinks it is bullish.
Okay.
Evidently. Dollar index is taking hit.
Okay, so this is your way of just taking pleading the fifth, letting the market answer for you, so you're not going to answer. That's okay, because we're going to unpack this information, especially when we get into outside forces. There's a lot coming up on the macro side. Before we do that, I want to give a shout out to G-Man, Taipan, Thomas, JB, Preet, Hello World, Light Signature, Gabriel, 734, Pradion. Man, that's a long name. And I think that's who I see in the chat. Welcome. Love to have you here. Hit the like, subscribe buttons. Definitely hit the notification bell so you can be aware every time we go live every Tuesday and Thursday at the exact same time, 9:15 Eastern Standard Time in the great North America. We're going to jump right in to the market updates as we look at the information. We've got a mixed bag, as I said at the top of the show. This is all about the crab walk. We continue to be in range, and the question, of course, is when do we get out of it? JJ, I looked at some of the data just before the show. I looked at the ETFs. They had a slight outflow of about $15 million. GBTC was also down about 28 million, but it's easy to say that they've clearly come back from the constant bleeding of over 100 million or 50 million every day. And yet when I look at the spot volume or spot price, BTC at about 61,000. ETH has finally gone under 3,000, sitting about 2,900, and then SOL about 143. You know, I'm looking at this data. It just continues to be a crab walk. Tell me I'm wrong.
Yep, just the chop solidation we've been pointing to. I don't think you're going to see ETF inflows go positive until BTC breaks out. That's kind of the dynamic that we've seen from them, is that they tend to be momentum buyers, right? Like as prices consolidating, you don't see a whole lot of buying from the ETFs. They are like everybody else, just waiting to see how this range resolves itself. And then I do think if we see price breakout in May or in June, possibly that's when you'll start to see those ETF inflows start to come in again. So I don't think you count as them as a leading indicator. They're more just a sign of momentum. If we look at the chart now, we see we came back down, retested the 100-day moving average, which we retested last week as well during that crash, and now it's trying to form a higher low. So we'll see how today plays out. But it's not the worst structure in the world, right? Like we kind of came up, made a lower high, now a higher low, and it's just that range that we've been talking about. Sooner or later, this is going to resolve itself. So it's just a matter of staying tuned here through the next week or so. We'll get that CPI report on Tuesday, and I think we'll have a better read on where the market's going to go after that. Right now, it's just kind of building up into anticipation of that event. Everybody's kind of risk off. We don't know which way it's going to play out, and you can kind of see that being demonstrated in the chart structure here.
Chart structure telling us everything. I do want to hit on those flows a little bit. Benjamin, I see this headline coming off of X. Hong Kong's Bitcoin ETF surged $270 million in 6 days. We talked about it before on this show about how you didn't have a lot of anticipation for these ETFs to bring in a lot of flows. JJ was just pointing out that they're really not a leading indicator at this point. What do you make of the volume that we've seen to date coming into Hong Kong? Is it suggesting at all that we're going to see some more demand coming in from mainland China, other parts of Asia? Is this just kind of old pent-up demand and sort of baseline of what you expected to see?
I mean, there is still money coming out of China, right? It's still exiting from the mainland and trying to get parked in various countries. So there's no surprise that the Hong Kong ETF sees an inflow in the first week of launch and potentially continues further on. But the real benchmark continues to be BlackRock's IBIT ETF because the market sentiment, I mean, we had these inflows and still market was not bullish, was not behaving that bullish except 3-4 days of price action, and then we've just been bleeding, right? Market is still considering BlackRock as a benchmark, even if GBDC sees an inflow, which has not happened in 70 days or so. BlackRock ETF continues to be the benchmark, and if that does not see the inflows that we saw back in the day, like, $500 million, $300 billion, and so on, it's not really strengthening back the narrative on the spot ETFs. Like, it doesn't become a solid metric that people rely on. So it's good that we are seeing positive inflows on Hong Kong side in ETFs. It's great, fantastic, but I don't think it is a metric anyone is using for deploying volume at the moment.
Okay, so it's really not anything more than it's really not that exciting. You're suggesting we really want to be looking to IBIT. IBIT, if I'm not mistaken, over the last several trading sessions, they've had very little volume. In fact, this week, none at all coming into the ETF. They're still averaging about 188 million based on what they had for Q1 going into this month. So still quite high, and interesting to see if that starts to turn around. JJ, let's look at some of the other data that we usually do on this show to kind of unpack where maybe people are starting to position. I looked at the options expiry. It looks like it's unchanged since we spoke on Tuesday at the end of the month. Still about 3 billion notional volume, still sitting where most of the volume is between either 50,000 puts or 80,000 calls. And then I did see a decent amount of volume on the perp side as well. I want to get a little bit of perspective on that basis trade having come down a little bit. Are you seeing anything there where anybody's starting to make a move, maybe trying to front run where this range is going to break, maybe even trying to front run the news of next Tuesday when we get that CPI report? We talked about that on Tuesday, about that potentially being a catalyst. If we see some of that inflation numbers come down, it could really spark this idea that we're going to see rate cuts.
So right now, we have the large option expiry coming up on tonight into tomorrow, and that max pain point's at 62,000. So you see again, the market makers here are basically going to win so long as nothing drastic here happens today. We've got a pin price in this perfect range once again, and then that's $1 billion in notional that'll be rolling off. And then as we go out to May 17th, we see that drops down to 678 million. And I believe May 24th is lower too, yeah, so 390. And that's all leading into the larger expiry at the end of the month. So there's a couple, these next couple of weeks, there's not as much friction in the options market as there was this past week. Like that's why when notional is larger, it becomes more lucrative for the market makers to pin it, and it causes a lot more friction for price to move beyond those ranges. So that's why when we got up to 64,000 this week, you see this open call interest. And if price basically moved beyond there, market makers were going to lose a whole lot of money. If price stayed below 61,000 for long, market makers were going to lose a whole lot of money this week. So that didn't play out. They kind of got this max pain pin that they were looking for. And it's basically what we expected, right? Is that they're just pinning price in this range. Nothing too much is happening. We saw some bets come in yesterday. Like there was a lot of hedging taking place. There's a lot of put demand, and that sent the skew negative, which is basically you see it here on this chart. When this goes below zero for these contracts, that's showing you that people are paying more for out of the money puts than they are versus out of the money calls. And we saw this also a week ago as price was crashing. And you could think of that like negative funding in the options market, essentially, where the cost to short or buy put options is charging you more than the cost to buy call options. It's kind of an abnormality, but that's kind of signifying that people might be expecting or at least hedging for a bigger drop next week. In terms of other flows, there's been continued call buying for September and December expiries. Just I think that's a measure of how cheap the implied volatility term structure chart's gotten. So if we want to take a look at that, we see that this is something we've been covering, just how low these IV levels are throughout the remainder of the year relative to how high they were in March. So if you were to look at September expiries in March, these were trading closer to 100. Now they're just at 58. So the cost to buy a September call option at 80 to 100K is 50 to 80% lower than it was just a month or two ago. So there's opportunity there, and it seems like people are beginning to position for this range to finally break, which, as we've been saying, it's not going to stay between 64 and 60 forever. Eventually, we're going to see some kind of movement here, and I think it's shaping up for that to happen at some point next week.
JJ, you just talked about a little bit of that positioning where people are buying or looking at some of those December calls. What about on a spot basis? Do we continue to see the whales buy?
No, there's a whole lot of nothing going on in spot right now. If we pull up that divergence chart, I believe it's just been showing more of the same. Not a whole lot happening there. If you look at these spot volumes here on Coinbase, it's just kind of been dwindling over the past month. And it's not really going to be, I don't think you'll see too much volume come in until we firmly lose this 100-day moving average or make a break above the 50-day moving average. That's typically the way price tends to behave around those key levels. And then once those levels are lost, you'll see people either panic selling or panic buying, and that'll really extend out that move and that range break, and that's what'll drive the price action from there. But for now, it seems like everybody's sitting on their hands waiting to see how this kind of shakes out over the next week or two, as price has been digesting this range for quite a while. So it seems like it's getting time to move here.
Benjamin, I want to bring it back to you and ask a question on the perpetuals front. I was looking this morning at some of the volume there. The open interest was sitting about 16 billion. This is coming off of CoinAnalyze. Liquidations, pretty small, about 27 million. But a couple of things stuck out to me. When I looked at the long-short ratio over the last day, longs had definitely gone up. We're sitting about 63% versus shorts sitting at 36%. And then when I look at the basis trade, I was seeing that on the largest area, so that'd be Binance and OKX, the largest volume, basis trade was sitting about, and I'm looking at it right now, about 7, just shy of 8%. What do you make at all of that basis trade coming down? I think just maybe a month ago, that was at least double that, maybe 2.5 times that on the basis trade front. As that starts to come down, where do you think that indicates where some of these traders may go?
I mean, overall, there is a declining activity right now, whether it is on chain or on the centralized side. So that's also what is ending up reflecting on the basis points, on where there is degeneracy or not. I mean, you want basis to be quite high for a prolonged period of time in a bull market, right? And with Ethena, Arthur Hayes' project on Ethena, the stablecoin model on using long short ratios and funding, that is something that we have to see how that is also going to impact the volatility in perpetuals and funding rates and so on. So right now, this is basically, there is a growing consensus still that it is still sell in May. It has an excellent success rate from the past, and the narrative that the ETF marketers probably will go on a vacation quite soon. Q3 is coming, so typically people go on vacation, and Wall Street doesn't work so much in that quarter. So all these narratives and basically is also impacting the open interest growth on the native terms. On USD terms, sure, you can have it, high values. But when you look at the native contracts that gets opened, that is what matters. The number of BTC contracts that gets opened, that is still muted. And if you look at meme coins, we don't have any new meme coin doing a crazy all-time high, nor Ansem coming up and giving a lecture on how if you're not issuing and trading a meme coin, you don't deserve to exist in crypto. Like you don't have anyone coming and saying that.
If you're not taking,
so it's like everyone.
I was going
everyone
to say, taking life advice
and
and financial advice from Ansem, I'm not going to endorse nor disparage. I'm just going to leave it at that. Stay neutral. But sorry, go on.
Even, that's what I'm saying.
We're
even
not
those guys are neutral
is what
right
I'm
now.
hearing. Yeah.
Even those guys are neutral right now. And it's like, see, this is not new. We see almost every halving cycle that there is a pause that happens. The only difference is that last cycle, since the liquidity was also coming in a crazy level, there was an easy overflow into altcoins. The DeFi summer was basically created at that point, and it worked to the advantage. So it gave more time for BTC to consolidate. On the other hand, right now, the doorway is ETFs, and it's like there is a cluster effect that everyone comes in at once, or there is a sidelines positioning that happens for quite some time. So there's just two approaches that keeps on happening. It will take some time for this network effect from halving to start impacting with respect to circulating supply and so on, lending markets, all of these markets, how they will react to something we have to wait and see. This week, for example, it was a Bitcoin and Ordinals conference, I think, in Hong Kong, and apparently everybody's bullish on BTC ecosystem, but we are still yet to see a lot of transactions open up.
Yeah, I was going to say, I mean, it's great to hear some of this. We talked a little bit at the start of the show about these the narratives of what's coming out of maybe the flows going into Hong Kong. We're still looking at IBIT. IBIT's still down. Then we're talking here about people being at these conferences and having narratives. Great, but we're not seeing the data. So I think to come back to your point, there's a delay that's typical after the halving, where the market is digesting the information, digesting the new issuance of supply, and it takes a while before that starts to be a catalyst to see some kind of movement. So either have that start to pick up, or we have outside forces, or we have both.
Yeah, absolutely.
Yeah. Okay. Okay. Well, last question here. This one's it's going to be difficult. If you're selling in May and going away, where are you going? It's got to be somewhere nice. You go into the Bahamas? You're gonna go to Thailand to sit on a beach for 3 months?
Nah, I'm going to base. I'd go to base and sit and dig more and more on tokens, study the holders, deployers, build more screeners to figure out what we can deploy.
I want everyone to pay attention to what he just said. Benjamin, if you follow him on X, and shame on you if you don't, I think you put out a tweet within the last week or so that basically said the next couple of months is your time to be doing investigations, researching, finding those opportunities. He just hinted at where he's going to spend that time. So if you're looking for places to find some undiscovered gems, I suggest you go follow his trail and go to base, it may be a good place to find that. Okay, I do want to get a little bit more into, we talk a little bit about outside forces. We can talk a little bit about the macro. JJ, I do want to come back to you. Anything else, though, from a BTC standpoint that you're seeing right now, from a data standpoint, that maybe has struck your eye and worth sharing?
No, it's chop solidation. That's all. That's all there is to report right now.
You're just making up your own words as well and trying to create your own narrative that you're going to spin out there.
If we do, like, here's an interesting chart, though. Here's some liquidation pools, 100x liquidity pools from the past week. And we see there's quite a lot stacked up in both directions. So could easily come down here and take out this 59.5 cluster or so. Or if price catches to the upside after CPI, I could easily see this take out the 64.5. And this forced buying could send us back into a trend gain. So if you look at where this would put us, we'd obviously be above the 50-day moving average at that point, and then the chart would look very bullish, and I think that would bring some kind of technical people back into play, and the market could really catch steam pretty quickly. So just be aware that there's a lot of liquidity in both directions right now. It's just something to keep an eye on.
Yeah, I would say when I look at that information, the fact that we've been covering as long as we have, it feels very much like, know that we're in this range. I mean, going over 60, under 60 within this range really isn't that exciting. Nothing really to worry about. Certainly, I guess if you have capital and you're waiting for it to break down, it sounds like Tuesday is where, and maybe just going into next week is where we may start to see that based on the CPI report. Yeah,
I think that's when it'll ultimately we'll see some signs of life from the spot market in one direction or the other. Shortly after that CPI report, maybe we start to see it front run one way or the other over the course of the next couple of days. But until then, you could probably just safely assume we're in this chop zone.
And the chop solidation sounds like a B movie from the 80s. Bounce. I saw this from Thomas. He says that he sees some information on chain suggesting that that I believe he says is bullish, some accumulation. Notes bounce from stake cost at 59.8 thousand. ETH staked realized cap still sitting at lows, and BTC LTH increasing their holds. So I guess there's some information on chain that maybe shows some of that accumulation. So that's interesting. I want to, I guess, share that for all the viewers or all the listeners. There may be some information out there showing some of that. I think some of the data that we look at on a recurring basis, either with Tara or some of the information that comes off of Panda, suggests that it's kind of more of the same, but not a huge shift. And then Therms, I see, how shocking that DWF manipulated markets. Well, I
shocked.
Yeah, shocked. What do you guys, what's your perspective on how manipulation starts to change as this becomes more mature? Are you expecting it to increase, decrease? I mean, we see manipulation in TradFi markets, although they want to act like it doesn't happen. JJ, what's your perspective? Is it going to be harder for organizations like DWF to do this manipulation?
Yeah, harder for smaller manipulation or smaller shops to do it, and it's because the larger shops are going to come in and manipulate it for themselves. That's it. You're just passing the torch from one to another. Anytime there's a market, it's prone to manipulation. It's just kind of the nature of the beast.
Benjamin, what's the perspective, the Asian perspective on this manipulation? It's going to continue for a while, or is it end of days?
I mean, as far as traders are concerned, what I would say is let's keep it going, because more than half of 2023, if not for DWF's manipulation on token volumes, we would have had a dead market. The amount of consolidation we used to have on BTC and ETH, for instance, the only reason why there was any excitement and so much push on AI side, all of it was basically a lot of their portfolio projects that they were taking up and pushing the prices up. Well, see, this is the thing, right? So the definition of manipulation is a bit sketchy when it comes to like, sometimes I put myself in someone else's shoes and start thinking about it, right? So when you go for an IPO stock and let's say the stock is getting listed, and in stock markets as well, obviously you're going to have market makers and traders and blah blah blah, everything. And every counterparty is recorded, and what type of transactions can happen, what volatility is acceptable. If you get a 5% pump, they basically freeze the market, and and still everything is still quite illiquid, even if you take stock markets, individual stocks as far as they are concerned. And now you are coming into the space which has an on-chain side and an off-chain side, right? On exchange side, and then there is also on-chain, and then you also have OTC. Now, in such a fragmented liquidity situation, when it's a new token that's coming up, and it's probably they have like $1 million of liquidity that they've raised on the project, and they basically want to provide exposure and push up the price. Let's say it's not discussed that they will push up the price or push up the price, but the token allocations basically result in doing that, right? There is only so much you can do to not get categorized as a TradeFi definition of market manipulation. I do think almost every single market maker who's taking up token market making projects in this space are doing it one way or other. Either they have option contracts with the projects in such a way that it is extremely profitable for them, or they know how to push up or push on the prices, and there are people following these guys on what they do, whether it is on-chain wallets or whether it is contracts or whether it is Twitter post. So sure, probably 30% or 20% of it was manipulation, but 70-80% was basically they had no choice. There's nothing else that could be done. Like this is how basically new tokens work.
I'm laughing a little bit. It sounds like a defense of the indefensible, but it's also a realization of how the system is currently operating. JJ, I want to get your perspective there and just a rebuttal, if you will. We've talked a little bit on this show about how retail feels at times they're tired of being dumped on. This comes out. I do want to add. I have this. Excuse me. I have this tweet from April 29th from Jeff Dorman, who is, I think, the chief at Arca Investments. He said, "I used to buy every IPO, direct listing, and new debt issue because they almost always went up, priced correctly by iBankers. I run a liquid crypto fund, and I wouldn't touch a newly listed token on Coinbase or Binance because the process is flawed." He's putting his perspective, and they've also they've put out. We don't have time to get in today, but they put out an article on what they think should change. JJ, what's your perspective on that? Is part of this just acceptance of how the market operates? Is there is there room for improvement that would make retail better off?
I think it just is what it is. Like it's kind of a necessary evil. If you need liquidity, you have to get it by these ways that aren't so efficient for retail, but that's kind of the price you pay for having these liquid tokens and the opportunities to jump into them. So it really requires a lot of research. You have to understand things like FDV and whatnot and exactly what it is you're buying. And like that, I forget who it was that you just mentioned, like he pointed out, like they're incorrectly priced most often of the time, right? But so are IPOs. Like look at recent IPOs, they don't do too well at all. And that's because by the time these things finally go to market, they're way overvalued and they dump it on retail who's just happy to buy an IPO because they think they're getting in early. But it's just essentially an exit liquidity event for people that have been long in the private space. And that's basically the way most of these tokens function as well. So just understand the game you're playing. But due to the flip side of that is you get some wild pumps from time to time too. When the market maker needs to juice up the chart, they can do that successfully. And if you can trade well, it creates opportunities to do that. So it's a give and take, but it definitely creates opportunities when there's more liquidity. So it's a necessary evil.
So the old adage, know the game you're playing.
I don't think it is possible that you can get this space, the crypto space, when it comes to token listing and market making, equivalently regulated and organized as it is in stock market side, in the TradeFi side. I don't think it is possible because the elements that are involved here, it's widely different. The network effect is huge. It's like it's not anymore about one company stock that is getting listed. It's about USA stock getting listed. Like it's a country's token that is getting listed when it comes to crypto. It's about a network and its currency. We cannot look at it the same way as stock market instruments. We have to be looking at it like currency instruments
Yeah, that's
when
a
it
good
comes
point.
to crypto, because it is a protocol or it is a network, it's a layer one, layer two, and then you are using these tokens as a currency to engage in that network, right? I mean, of course, the DAO components is very different, but if it is any type of utility token or anything that has some utility inside that app, then that is very different from a security sale, basically, that happens about Zoom or Twitter or Meta. So it's a very different use case. So I don't think trying to put in the same measurements and saying, like, hey, I'm going to measure a fish and an elephant in the same way and expect same results to happen, or the fish is wrong. No, that's
Yep.
stupid.
Mhm.
No, I think there's a lot of truth in what you're saying, Benjamin. And to be fair, I brought up Jeff. I did read his article. We don't have time to get into it. I'll remember to put a link to it in the description for those who are interested in getting a little bit deeper here. I would agree with you. I think some of the comparisons that Jeff made in his article for ways to remediate this space were too. They thought about the crypto allocation or the coins like stock. And I agree. I don't think that's necessarily the right model to use. So definitely an interesting discussion. I think that, again, I'll kind of harken back to what I was saying before. Know the game you're playing. Maybe another measure is to say, don't be the first buyer. Wait for this to be digested a little bit because you don't want to be exit liquidity, which unfortunately is all too common. So, okay, let's move on to some of these outside forces because as we said, they're going to be playing a major role whether or not we're able to break out of this range. And we could see the next one coming as early as next Tuesday, which is May 15th. That's when the CPI report's coming out. And we've talked about some people are already suspecting that we may actually see a lower read, which could suggest that the 2% target that the Fed is looking for is more attainable. It's in striking distance. And if that is the case, we may actually see them look at some rate cuts later in the year. But JJ, let's walk through what the Dixie is telling us right now.
Yeah, so it popped up. It's kind of doing a retest. It obviously lost a lot of momentum last week after that jobs report came up, retested some of that lost momentum, and then it's fading this morning after another bad jobs report. So it's hitting at potentially a reversal here, but I think CPI will ultimately be what confirms that, is you would see it break down below these lows of last week, lose this 50-day moving average, and just continue lower. You see there's a lot of key moving averages here on the daily chart. There's the weekly Bollinger Band, which is below that 50-day moving average. They're all pretty packed together here. The 200-day moving average and the 100-day are all around that 104 area. As well, it's sitting on the 50 RSI, so that's key for momentum. So you could see a favorable CPI report really nuking this thing downwards, and I think that would give some potential for upside in BTC, and we could finally see it resolve out of range above 64K. But I think, again, it's dependent on that CPI report coming in favorably next week, and then seeing the reaction from DXY. Right now, it's just kind of consolidating above the lows and below the highs. So we're just kind of chopping about in the same fashion as BTC, which probably isn't a coincidence.
Did you make anything at all of what you saw about the Japanese yen coming out and having basically being rescued, so to speak, by the US dollar, I guess with some swap markets? Does that give other currencies maybe hope that they're going to receive the same treatment? And does that matter in terms of trading? Are you looking for anything to suggest that this could bring about some weakness in the dollar quicker than expected?
I think we would, like, if it was a major event, we would have seen the dollar fall below these lows, like if it was something totally unexpected. But the fact that Dixie held up despite that announcement, I think that's just telling you it's basically a non-event for the time being, at least. I would say if you see Dixie start to lose a lot of momentum here throughout May, that's probably a good signal that, hey, there's some kind of stealth QE or whatever you want to call it going on that's adding liquidity to the system. That's just kind of your gauge. Like, that's the way I look at Dixie, essentially, is when it's extremely strong, it's telling you liquidity is contracting. And when it's weak, it's telling you that liquidity is coming into the system, which is ultimately good for risk. And right now, we don't really have a firm signal one way or the other. So it's just waiting for that to confirm itself. Either break down below 104, I would see that as a good risk-on signal, or obviously if it breaks out back above 106, then you're kind of looking at that worst case liquidity Armageddon scenario where things get out of hand for a while. But right now, it's just waiting for the price action to confirm itself. We don't really have a clear read one way or the other, which is pretty typical to what you see into these events. You don't really have a clear reading, but it seems like the momentum's fading, and a CPI report that sends this lower, I would probably lean towards that being like probably 70% odds at this point, based on what we've seen in the jobs data. That Cleveland Fed forecast says it's going to come in negative. So I think there's a lot of things pointing to the CPI playing favorably for Bitcoin and risk. But again, you don't want to bet too much on that in case it's not, right? So wait for the confirmation. But if you see it, know that that's your opportunity most likely to get into a nice long and potentially ride this back to 70K or so.
Yeah, and I just want to extend that point. I'm seeing this just come up right now on the news. Jobless claims spike, a 9-month high surprise. So that's kind of the headline news, and I think we'll have to digest that over the next day or so. But it looks like maybe some of that is coming in a little bit stronger, these jobless claims, which could, I would imagine, put some pressure on the Fed when they're trying to look at when, in fact, they may want to loosen up policy a little bit. Especially, I guess, if we start to see that kind of spike and then we start to see inflation coming down, they may see an opportunity.
Yep. You see it here on the chart too, right? Like it's lost so much momentum over the past week, basically since FOMC. That does look like it's due for a spike lower. So potentially promising.
Benjamin, I want to ask you a question because obviously we don't look necessarily for FX rates. That isn't really our area of expertise. But I guess from a on-the-ground perspective, talking to your peers, thinking a little bit less about North America, a little bit more about different geographies. I just talked about the yen seeing a rescue package, so to speak. And I know there was a question here from Run the Jewels. Can you break down the swap markets or swap lines? I don't think today, and definitely I'd like to have Ben Lilly come back and discuss that when we do, because he's got a deeper insight into that than I'm able to. But I want to get your on-the-ground perspective from traders. Are they looking at some of the macro policies in those other geographies to maybe loosen up some liquidity that's coming in, or are all eyes on the Fed in the U.S. because that's the biggest whale in the water?
Okay, so since you're asking, I was meeting one of our clients. I was meeting one of our clients for dinner a few days back in Dubai. He was visiting, and we were having dinner, and this is a guy who has more than 1,000 Bitcoin in his portfolio. His primary business is different, and he's a holder since like 2011 and 12 periods. So he was saying that in his perspective, he's looking at 2 more triggers that's pending, and until that happens, probably we still don't have the actual bull market to have started. First one was rate cuts. And the second one, he said, it would depend on what happens to rate cuts and elections. If it is going to be Biden coming back, then that's going to be horrible. If that is not the case, anyone else basically comes in, you have a better trigger. So he is not a fundamental macro analyst or anything, but he is just an investor in crypto from Asia, and who does a lot of volume on chain and off chain, makes investments in different products, different verticals, has multiple businesses in Belgium, UAE, and so on. And what I could see is like they go with very simpler perspectives. Is this happening? Is this happening? That's it. I'm not going to sit and look at M2, M1, M3. I'm not going to sit and look at TGA. I'm not going to sit and look at whether TED Macro's crypto liquidity index has flipped or not. Are the rate cuts going to happen or not? When is the first cut happening? Let's start deploying them. They have very simpler perspectives.
So what I'm taking from that is, even though sitting in Asia, investments in Europe, all eyes are still on the North American market, right? Both from a political standpoint as well as the Fed.
Yeah,
I mean, it's
because
simplified down, but it's
because
still
there is
not
a very
looking
clear
at.
understanding.
Yeah.
There is a very clear understanding that dollar liquidity is what drives global markets.
Mm.
We can debate about it, we can celebrate it, we can bash about it, but it's the truth.
Yeah.
It's the spending economy which basically drives consumption all around the world, production all around the world. Of course, Asian economies are trying to break out of that barricade and cater more locally, but those are still economies which are basically devaluing their currencies in order to survive. Whether you take India or China or everyone for that matter, right? As long as the reserve currency still remains dollar, the focus continues to be on dollar.
Yep.
And BTC doesn't behave any different when we take a S&P 500 and dollar index, isn't it? So, yeah.
So, yeah, no, I appreciate that on the ground perspective. Obviously, one man's story rather than a survey or something like that. But I think it highlights the point that one of the reasons we spend so much time talking about the Dixie is that it is a very reliable gauge of global liquidity, which is going to be impacting our little world, which is just a couple of $1 trillion relative to the hundreds of trillions of dollars sitting in every other asset class. So what I would say to everyone who's out there, if you're interested in understanding how this is going to really play out, how these outside forces are going to impact us in the coming weeks and months, definitely I'll be following these guys on X, but also come back on Tuesday, Thursday next week. We'll unpack the news that's coming out from the CPI and whatever signals we're starting to get from the Fed. And then maybe we can get into some of these other questions like how the swap lines may be used for some of these other jurisdictions and maybe some of the impacts we may see from a Dixie perspective. All right, well, let's transition and talk a little bit more about positioning. Before I do, I want to say a welcome to everybody who's in here in the chat room showing up today. Definitely appreciate you being here every Tuesday and Thursday at 9:15 Eastern as we go live. Definitely hit that like and subscribe button and share this broadcast and any of our other live episodes wherever you like to talk about crypto. We'd love to hear your thoughts on the analysis, what you'd like us to go into further, and obviously share this with anybody who's trying to get a better sense of how the markets operate and get beyond the influencer type of noise that we really try to break through. Okay, JJ, I'm going to come back to you every time we have kind of a rotation of what we're looking for from a play, if you will, right? An opportunity. We talk about setting up these options plays, and I'm sure we'll look at CoinCall in a minute. We talk a little bit about the miners, obviously looking a little bit at ETH, which is also in the options market. So, and I guess if you're looking today, has anything changed at all that you've seen that's really started to come on your radar that's getting you excited? Is it still the same options plays we've been discussing the last couple of weeks?
I think this is a good time for straddles, which is where you're long the put option and also long call option. So I think those call spreads that we've been discussing, where you're long either September or December calls around 70K, I think those will continue to be good positions until we see some resolution here. So I think you still want to hold on to those. Like say if you're holding a September 70K call for 6.6, I think that's pretty good pricing still. And if you wanted to be a little safe on that, you could sell the June expiry against it for 2,000. Essentially lowers your risk on that to around $2,000 $4,000 rather than $6,000. And then to protect your downside here, because if we look at this Bitcoin chart, obviously if it loses these lows from basically last night or so, we could easily see it dropping down past last week's lows as well. So you kind of want to be in position for that ahead of CPI rather than panicking if CPI comes in and Bitcoin crashes, right? And if you look at the cost of put options here, let's go out to May 24th and take a look at those. So if you look at, say, if Bitcoin does fall, I think the odds of it taking out these range lows at around 56K are pretty good. And if you look at those put options expiring on May 24th at 56K, they're only 690 currently. So if price does get back down there, say next Tuesday comes, Bitcoin crashes, falls to 56K or so, these will probably be worth around $3,000 to $4,000, possibly even more if there's enough panic hedging going on. So I think this is a pretty good risk reward right here. So you had these 56Ks and then you have that longer dated call exposure, which you could ultimately add to or cut if you feel like, we're just entering a total bear market after whatever plays out over the next week or so. But I think these volatility levels, if we look at the implied volatility index, I think these are at pretty favorable levels relative to where they've been over the course of the past year. So you see how beaten down this index has gotten. It's basically undone that whole leg up from February through March, and it's just been washed out. And there's nobody really interested in buying volatility, which is usually a good time to buy it. When everybody, like up here, everybody wanted to buy, call contracts and speculate on BTC going to 100K. And now that it's down here and price has just been chopping, there's a total disinterest in the market. Those premiums for call options are totally wiped out. And I think it's presenting a good risk reward opportunity to go long some longer dated calls in case we do get that breakout to the upside. Again, if you look at those liquidity pools, we see like if price does catch momentum over the next week or so, gets back above 63K, you could just see these liquidations happening. And at this time, volatility would spike. You'd probably see BVIV go up back to 60, 70, and that would bring some nice premium gains to your call contract. So I think that's a good risk reward here. And again, you have a whole lot of time to your advantage on those, so they're not going to go to zero overnight if you're buying a September call. I think that's a good way to play it, and you hedge yourself with a shorter dated put option in case we do see a spike down.
There's a lot there to unpack. I think that's a really good way of thinking through, walking through the trade. If you take the macro analysis you've already done on Bitcoin and then combine that with sort of the perspective that you just shared, it's an interesting way to think about a trade setup and potentially see some profits even within the crab walk. I do want to say for anybody's out there, we have had some questions from people just asking like how to get started. Definitely, we're giving as much information as we can on this show. Obviously, JJ just released a video, his latest in his education series on options. Definitely check that out. We'll remember to put a link in the description for that. And go check those out. And really, you can rewatch those, obviously, to get a better sense of how do you start that options journey when you go from a paper trade to actually executing some of these trades. We're going to continue to put some content. In fact, we have some content coming out tomorrow, also from JJ on some metrics. We're going to continue to build to that. But I think that's the best place to start. I will say we're already talking a little bit more offline about how to give a little bit more of an opportunity to dive in, unpack some of that option strategy. So if you're interested in more of that, I would go ahead and sign up at CoinCall. That's going to be part, I think, of that journey to have that sign up complete. And then we can come back, and as we start to roll out some of these other capabilities in a TBD world that we're building, you'll be first in line to be able to access some of that and get some deeper insights from JJ. And as I was going to say, if you haven't already and you're interested in options, CoinCall is the place to do it. I know I talk about it every episode. It's what he just shared on his screen. It's what he has in his options video. They've got a nice, elegant interface and competitive prices. I really can't say more about it. If you're interested in options, that's the place to do it. All right. So from that positioning, you have two ideas from an option standpoint, could be profitable, even if we have a crab walk. Benjamin, I want to turn to you. We'll wrap up this show with you because I don't expect any specific calls to come out, but what I'd like to understand is what is the framework you're using as you're starting to look at opportunities and you're starting to do this research? I think just to highlight again, you mentioned on X, now is the time to be doing the research before the bull run really gets into its next phase. So how are you setting up to look at tokens? What exactly are you looking for? How are you going about your research? How are you using the tools that you have available at your disposal that maybe some of the listeners don't have to really dig into some of these opportunities?
So when it comes to new ecosystems like Base, there is difficulty, because information is still quite fragmented. There is no easy way to find out, hey, I want to know about a casino product in Base. Where can I find it? There's no simple way to go about it. So there's a lot of social media digging. There's a lot of CoinGecko digging. There's a lot of chat room digging that happens to find information about a variety of products that's getting built up. This is on a fundamental level. On the next step is, of course, the on-chain level, right? So when it comes to on-chain level, before that, of course, you have the friend.tech, Farcaster type of DApp products, which have been building on Base, and a lot of discussion goes on in that space as well about what could be the next projects that's going to do well in Base. But these are all hearsay discussions when it comes to fundamentals. A lot of products still don't have anything. So what do you do? If the tokens are still up on those, then comes on-chain digging, right? Finding out who are the deployers, what are the common tokens that these deployers have earlier traded across, what are the type of holders, are these whales, what type of activity these whales have done in the past, is the contract secure enough, and then what does the project do? Is it seriously valuable? Is it having any traction at all, or is it just on-chain market makers creating volume and pushing up the prices and are accumulating? On top of which, we have a few stealth wallet accumulation type of thoughts through which we are able to determine and make a list of tokens that could have a good potential in base. These are all still quite nascent research if you think about it, because it's still a wild west when it comes to base, when it comes to Solana too. So nothing concrete, but it gives you a much streamlined picture to say, okay, from the 10,000 tokens that's getting listed in there, I have a list of 300 tokens or 100 tokens to look at. Then you start to figure out what type of portfolio allocation you go for if you want to gamble in this specific approach. The fundamental thesis, I think everyone knows my fundamental thesis when it comes to base, on why I am bullish on base. I don't want to repeat it every time, but the fundamental thesis is that before the bull run is over, at some point, base is just going to see rapid growth in volume. It's an infinite money glitch type of an approach to spike up Coinbase revenues. So potentially, as long as it is not a rug pull project, as long as the deployer is not an outright known scammer who has deployed many other scammy projects and rug pulled, you still have a better shot at making returns. It also depends on seasonality. If we are in a sell in May and go away type of seasonality, then you have to be prepared for holding tokens over a longer period and getting into, like how far you can hold and just see through. So it's a mix and match of multiple things.
Yeah, it's a mix and match. It's an interesting breakdown. I mean, I would highlight there that you can see a lot of information coming in from influencers, regardless of the channel you're on, be it Reddit, be it YouTube, be it X, saying about this is the next great token. It is still the Wild West, right? It is still very difficult to validate some of this information. So you got to put that into your framework when you're looking at the risk there. I guess, but still, as you said, good opportunities. A rising tide could lift all boats, and obviously that boat could go very high if it's coming off of base. Do you, when you filter down to that 300, do you look at some of the crypto narratives? Let's call it gaming, or let's call it AI, or obviously meme coins. Does that play into it at all?
Yeah, that plays a lot into it. Anything that will have a social effect, a network effect. Let's say casino products or gaming products, AI, deepen, or decentralized GPU, and all these type of ideas. That has a lot of traction, whether you like it or not. People like it. People want to invest into it. There's a lot of fundraising still happening in that sector. So if those type of projects are, even if they are clones of, if they're master copies of the ones that are getting deployed in Arbitrum or Optimism, and getting deployed on Base as well. But if the narrative is there, and if the interest is there, and if it is, let's say, a team which is genuine, even if they were not going to build it at all, but genuine and not rug pullers, it's probably going to make some money. So yeah, this whole base game is a risk play. It's a high risk play. It's nothing. Well, it's far better than just sticking to an influencer like Ansem or anyone and just jumping into every single meme coin. Yeah. But it is not efficient as our Bybit market data screener either. So it's somewhere in between. So it's a choice that you decide to make. Let's say 5% of your portfolio or 10% of your portfolio, you want to put into something like this and see if you can do a 20x return. if that is something that excites you, grinding a lot of time and effort in a sideways market, nothing wrong.
All right. I think that's a good breakdown. As good as it can be. I think having a very rigid framework is difficult in the Wild West. I would say, to wrap that up, Run the Jewels said, so Benjamin is saying he's all about the base, no trouble. Wow, I love that reference. I think that's going to do it for this show.
Freebasing.
So say that again?
He's freebasing, yeah.
Oh, geez. Now the references are going to come out. All right, Benjamin, if you don't have a base tattoo somewhere over the next 3 months, we're all going to be disappointed, given, I don't know, at some point I'm wondering if you're getting an affiliate link for him. All right, but with that, we are going to wrap up the show. I want to thank everyone for joining us today. Definitely be sure to check out the videos that are coming out tomorrow. They're going to be coming out starting 9:15 Eastern. And they're all going to be about metrics you can be looking to trade. So definitely check that out when they're coming out. And we'll be back next week, Tuesday and Thursday, with more of the insights with the team. Definitely suggest you check it out. Come here so you can ask questions. But with that, JJ, Benjamin, thanks for dropping by. Love to see you guys. Everyone in the chat, definitely hit like and subscribe button and come back. We want to see you again. Keep that dry powder. You're going to want to use it on base or something else. This is Marconi White signing off.